Apologies. Like I said, I think me and technical glitches, they go hand in hand. So anyways, like you guys are learning, I am also learning something new here. Now, so I repeat again, good morning all of you. A very good morning, and I'm sure you all are doing terrific. I'm also doing great, and I think when we are together, everything is just great. So I give you quick 5 seconds, and if you have any queries, any doubts, then you can put it in the chat box and I shall get back to you. Okay, so kindly put up in the chat box any queries or questions that you have from the previous 2 live sessions that we had. So just a quick summary in the meantime I'll give you to what we have covered in the previous 2 live sessions. We covered on the first day the basic concepts of costing, wherein we covered some detailed topics like what is costing, what is budgeting, a difference between flex budget, flexible budget, and fixed budget, master budgets, what are absorption costing, what is marginal costing, what is their relevance. Then we also touched upon standard costing, the types of standards, and for all of them we did a lot of questions. Also took an understanding of the how to prepare a direct cost sheet, basically cost sheet for a product, including the direct cost and the indirect cost, and how to proceed with it, how to distribute the cost among this fixed cost, semi-variable cost, variable cost, and so on. In the second day of the live session, that was yesterday, we covered about the topics like absorption costing, ABC costing, target costing in detail, along with lot of questions that we did. Okay, anyone has any queries, any issues, you all can discuss here with me in the chat box. If not, then I think we can proceed towards to today's session, which is again some very critical and small, very much those topics in which we require detailed understanding. So I'm covering these 3 topics today, which is life cycle costing, throughput accounting, and CVP analysis that you can see on your screen. Okay, so I think now we are good to go with it. So first I'm taking life cycle costing. So let's resume with this first one. Okay, let's proceed and let's go to the tab. Just 1 minute, please. Okay, let's understand a very interesting topic, which is life cycle costing. I'm sure you all know about a basic concept that life cycle means right from start of the product's life and going till the end of the product's life. If I talk about our lives, then what is our life cycle? Our life cycle is the way, the day when we are born and the day then the person leaves the world. Correct. So on the same lines, we have a product life cycle also. A product born means when the thoughts come in process, there is research, development, and then we have, the prototypes being developed. We have the designing phase, planning phase. Finally, the product goes into production. Then it is introduced in the market and then it grows. Okay. And it grows and grows and grows for many years, reaches its topmost position, like a maturity phase, and then it has a declining phase, because then the people have shifted their interest and their demands, and now they shift to another company's products, right? So this company's product goes low in demand, and finally the product is phased out of the market. Guys, can you think of any example that instantly comes to your mind when you see this process? Because one example that instantly comes to my mind, and that is, I think, everybody's first car, it used to be, that was Maruti 800. We all know about our favorite car, Maruti 800. No, if not ours, our parents' favorite car, right? It used to be the first car of every household. And now, coming back to Maruti 800, Maruti 800 was carefully designed, planned, and it was actually termed as the first car of the households. And then it was introduced in the market. It went into increasing sales, increasing demand, where it was really in good demand, and it was at a time that it actually practically had no best competitors to it, because all the other competitors' products were all failing against Maruti 800 and Maruti Suzuki 800, right? Because it was such in great demand that people used to come and buy it with its name, even without looking into. Sometimes the people did not even offer test drive, and they would just simply buy it. That was the value that this car carried. So now coming back to this, there was a time that it reached the high yields. And finally, with the other variants coming to the market, with the generation changing, interest changing, demands changing, requirements changing, people shifted the 800 to other cars. So what happened? They tried to bring the variant also. And why do we bring variant? So that the interest gets, there. And then interest doesn't get depleted. So initially it worked, but then finally it also did not work. And even after many tries, the Maruti 800 could not revive. So it was just going into the declining phase. And after going into the declining phase, it finally phased out of the market. It finally went out of the market, Maruti 800. Right? I think every one of you can completely relate to this. Right? I'm sure. So when I say this, everybody's thinking of their Maruti 800s, right? No, that used to be the first cars. Yeah, absolutely. Now I think let's proceed further, and I can take this more further. And now let's understand the concept of life cycle costing with the Maruti 800 example that I gave you. And also now generally, I think let's put ourselves into that life cycle, and let's understand the relevance of the same. Now I have a question, if anybody can answer that. My question is, nowadays, do you find any product to be as standing in the market for maybe 5 years, 10 years, 20 years, 30 years, the new products which are launched? Or do you find that the life has become lesser? The life of the products have become lesser as compared to what used to be 1980s, 1970s, 1960s. What is your opinion, guys? Tell me, what is your opinion? Yes, I think all of you can completely relate to it. But yes, you will say that, ma'am, generally the product's life cycle have reduced. Let's say iPhone only. Yesterday we took that example, so let me continue with iPhone. So iPhone, when it is launched in the market, have you ever observed why it is launched at such a high price? I understand the prestige it carries and whatnot. But don't you think iPhone makers, they also know, Apple company also knows that this product is not going to be there in the market beyond a year, because till that time many competitors will launch their products which will exactly be in line with this and much cheaper. So why would a major segment spend so much money on it, except for the ones who really want to go for an iPhone tag? Correct. So now whatever company wants to earn the profits by launching this product, they have to earn in this period of 1 year or 2 years only that they are expecting their products to be there. Correct? So this is why the life cycle costing becomes so relevant, because now the company's aim is to earn the profits that it desires in this entire life cycle of the product only, that is from the start till the end. So what does company does, or what do we do when we estimate the cost of a product, or when we create estimations for a selling price, when we create estimations for a profit margin? We calculate what is the cost that the product will be, that will be incurred on the product right from the start till the end. Let's club it together, divide it by the number of units that we are expecting to produce and sell in this period, so that we can have a tentative idea of what is the maximum cost per unit that the product will be bearing. On that, let's add a profit margin, and let's then see whether we can have this selling price in the market or not. Otherwise, we can have the target costing principles also applicable here. Clear? So life cycle costing simply says that whenever any price is fixed for a product, or a costing estimations are done, say traditional costing says you prepare the cost sheet for a year, for a 2 or so. But life cycle costing says you don't prepare it for a year or 2, you prepare it for the entire life of the asset. Okay, and when you prepare the cost sheet for the entire life of the asset, so then my friends, it is very, very convenient for a company to predict the costings that it is expecting to have, the margins that it is expecting to carry, and the sales price that it is expecting to charge to the customers at that price. Okay, so life cycle costing simply says, boss, don't bifurcate. It's a variable cost or a fixed cost. It's a selling cost or a production cost, or it's a distribution cost. You will take into account all the cost, R&D cost, marketing cost, distribution cost, production cost, even dismantling cost. Every cost you will consider, and then you will calculate your cost per unit. So whether it's a production cost or a non-production cost, every cost will be included here, whether it's a variable cost or a fixed cost. Every cost will be included here to calculate the life cycle cost, that the cost that will accrue throughout the life cycle of the asset, so of the product, so that we can estimate the selling price and the margins, keeping in mind the entire cost that we want to cover. Right? This gives the added advantage to the company that even when the margins may be a little bit low, but costs are all covered, so the entity would be able to survive the product throughout its entire life cycle that the entity has predicted. But yes, this can be a disadvantage also, because predicting the life cycle, creating the estimations for the same itself is very challenging. Right? So that can be a negative point as well. Now, let's go in detail and let's understand everything. So I hope my screen is visible to everyone. My voice is completely audible. Any questions anywhere yet you're stuck, anything, any challenges, do not hesitate. Ask me 1,000,000 times and I will respond back to you. Okay, so let's have our PM covered in complete confidence here. Okay, so let's go further. Now people, what is life cycle? Now I think we are well aware of it. It is a system that tracks and accumulates, because we take the total amount. Okay, so it is the system that tracks and accumulates the actual cost and revenues attributable to each product from development, right? What I said, start till end. So right from development till the abandonment. Very, very important. Please remember it. We would start from development and we will end at abandonment of the product only, and we will continue to accumulate all the costs that take place between the development till the abandonment. Okay, here I've taken a graph, a kind of a flow chart just to show you the product life cycle so that we can understand the different phases. Now, these phases are very important when you're writing your theory answer as well as when you are doing your practical questions, because these phases, they simply help you in understanding that what cost will go where and which kind of cost will be incurred in all these phases. That also I will explain you. Okay, now quickly. So before we introduce the product to the market, we have the development phase. Development phase is basically when the product is getting developed. And even before developing the final product, we have the research expenses, right? So we have research expenses, and then market research is done, product is finalized, then we go to the development of the product. And here we have the designing also. So here we have, please understand, in this phase we have planning, we have designing, everything is here in this phase. Okay, so we have planning as well as designing. Everything is there in this phase. Then we are going for a development of the product. Finally, when the product is developed, now what will you do? You will start with the production, right? You will introduce the product to the market. So second step is introducing the product to the market. Now there are two ways of which you can introduce the product in the market when it talks about pricing, right? So first is either we would try to enter the market at a lower price, right, at a lower price so that we can grab the maximum share of the market. Or second is entering the market at a very high price, because we want to maintain our quality and we want to maintain our prestige point. iPhone is the biggest example here, and Jio is the biggest example for entering into the market at a lower price, grabbing the market share and then increasing the market price, right? So that I think best I can give you is Jio example. So we are done with introduction, understanding, we're done with development, understanding. Of course, I'm going to take it in a bit detail also. Then comes the growth phase. So can you see? Now we are going in the growth phase where the profits are increasing. Revenue is increasing. Then finally we will reach a stage where our sales are maximum, because we have reached the maturity phase. Maturity phase means at this phase your sales are maximum. Okay. Yeah, so now we have reached the maturity point. Maturity is always the maximum level, right? So this is the phase where your sales are maximum. They have reached the maximum level. Now, after the maturity phase, what will come? Then, my friends, your sales have reached the max, have changed. And here, however, in this phase, company likes to bring in more variants also, so that the company doesn't lose the market share and the sales don't start declining. Even in the growth phase, the company brings variants so that the demand of the product keeps on increasing. Now, after maturity, let's say the variants are also not doing anything and the entity is not able to, just 1 minute. Hi guys, I hope I'm audible and visible. Please tell me. Because I just faced some internet issue, so quickly. Okay, I think I am perfectly visible and audible as well. Okay, so now let's continue further. So what we've understood here is the development phase, then we understood about the introduction phase, and then we understood about growth phase, maturity phase. Now the sales are going declining, so we have declining phase. Okay, we have the declining phase. Sales are diminishing, sales are going down, and now finally there will be a time you can see that the profits are going down, cash flow is going down. So what is happening ultimately? Everything is going in negative. Sales going down, profits going down, cash flow going down. So what is the result? The result is that the products will be sooner phased out of the market because it is no longer feasible for the company to carry on with this product, as it is leading to negative cash flows and losses. Okay, so now we will take the costings which are going on till the product is not phased out of the market, this point. So till the product is not abandoned, or till the level that the product is abandoned, we will take all the cost of the product and we will add it here. I will show you more details of the cost. We'll discuss examples also. So just focus right now. Now this is just a detailing that I've done here, and let's have the understanding of the detailing. We have already understood the concept. What is the life cycle costing? What are the different phases, right from the development and the introduction and the growth, maturity, decline. These 5 phases we are clear. Now just have a few texts to understand it in detail so that when we do questions, you would never be stuck. Okay, one first phase is the planning and designing that I've told you is the development phase. Okay, the product is designed and developed during this phase. Your prototypes are produced as we had discussed already, and manufacturing processes are created. See, generally in the product design and planning stage, my friends, your cash flows will be negative because right now we have not started selling the products, so we don't have any inflows, right? We are just doing expenditure, so here your cash flow will be negative, plus you will not have any profits also. Why? Because there is no selling that has started, right? No revenues generated, so nothing of that will take place. It is all negative here. Okay, now next, moving on, your introduction phase or the launch phase. Now the product is launched, but boss, which expenditure you will have here maximum? In the launching stage, when the product is launched, a company does a lot of marketing expenditure, a lot of advertisement expenditure, right? So this is the phase when we will have lot of expenditure of marketing, lot of expenditure on advertisement that will take place. Okay, now here, like I said, the company will have more of a negative cash flows here, like it takes place for startups, right? Startups, when they are in the introduction phase, generally have the negative cash flows, negative, and the profits are not there because still the sales have not generated much revenue, right? So therefore we have profits not being there, cash flows are negative because there's too much of expenditure that goes in the early phases. Correct. Now, quickly, like I told you, the pricing strategies, when you enter into the market with a high pricing, so that maintain the quality and the prestige value, and that with high pricing, with the profits you would be able to generate, because your product is such that even if the pricing is high, the customers like it. And there are some products, the more the expensive become, the more is the demand, like gold, like diamonds, like jewelries. Okay, so the more they become expensive, the more is their demand. Okay, like iPhone, with every product launch, the pricing becomes high, right? I hope I'm clear. So now here, what is that called as? What is that pricing strategy called as? So we call it as market skimming. Okay, we call it as market skimming. Market skimming simply means entering the market and getting that share with a high pricing. The Geo example, where they penetrated into the market with a very low pricing, with the only agenda that they wanted to grab the maximum market share with such a low pricing. So this is what we call as market penetration, which I'm sure you all are able to understand. Okay, now, so I hope I'm clear. Now, companies should always fix pricing in their introduction phase based on what demand levels do they expect in the future and how do they expect the life cycle cost to be recovered. So, based on which the pricing will be done. Whether they want to have the profit, covered by way of maximum units coverage or by way of even less units but maximum value coverage. Okay, so for example, a car like Rolls Royce, Audi, Merc, they don't reduce their prices. Every year they keep on increasing the prices because they know even if the takers are less, but the takers that they have are the takers who will go with this car because it is in the premium segment. So if they reduce the cost, it would not be in the premium segment and then the takers will wipe away. So therefore, they would never do a compromise of that sort. Okay? For example, setting a low price initially. Okay. Okay, setting a low price initially may discourage competitors from entering into the market. And what will this take place? This will make them have higher demands in the future. Geo, my friend, it is that example. Now, growth phase. Growth phase is the introduction phase is over. Now the product sales are growing. Though they have not reached the maximum levels, but they're still going up. So we are in this phase where the sales are steadily going up. Okay, this is the growth phase. Now, so what will happen in the growth phase? Now you are not alone. Apple iPhone is not alone when they introduce the product because post 6 months, new competitors entered into the market. In fact, post 3 months only. So that is their growth phase. First 3 months is their introduction phase. Next 3 months is their growth phase where they have the peak sales as well. So I think 1 month growth sales and 2 months peak sales that they have. Correct. And sometimes they reach the peak sales early also. So competition may rise due to new suppliers entering into the market and so they are forced to reduce the price. This is why you get iPhone 16 or 17, whatever it is, after 6 months you get at a lower price. Because then the competitors have entered into the market. So in order to remain in competition, they also lower the price. But let me tell you friends, the pricing that they set in the first 6 months only, they already cover their desired profits that they expect to be covered over the entire life cycle. So whatever they earn after the price reduction is only an add-on. Okay, because the targets are already achieved till that time. Okay, I hope I can go forward. Any questions till this point? Okay, let's go forward. Third step is over. Sorry. So we are done with the third stage. We are done with development. We are done with introduction. We are done with growth. Let's go to maturity. Maturity is the phase which everybody wants to be in always. Because your maximum sales, your maximum profits coming in this phase. And prices generally stabilize because the people are ready to buy the products here. So prices they stabilize here and which is the maturity phase. Okay, because the company generally remains here for long and the pricing strategies are that they always focus on earning the maximum profits in this phase because now they have reached the peak sales, peak profits. So they try to bring in strategy, different variants so that they remain in this phase for long. Okay, so then the focus becomes more of a short run, because the more that they will focus here in the maturity phase, the more profits they would be earning. Decline is, now the prices are falling because demand is declining. Okay, so then unless you can find an alternative market, unless we can find an alternative market, we cannot do anything, because markets will decline, demands are declining. Okay, so now this is just a summary that I have done, useful for your exam point of view. If I have to do the characteristics of the product life cycle, if the product is in development phase, you know the major costs are research and development. If the product is in introduction phase, we have sales, but it is very low levels, right? And fixed cost will be very high, like I told you, pertaining to advertising, pertaining to marketing, pertaining to acquiring of the non-current assets, because now the production is started, so we want to acquire more assets. And that is what we call as very high fixed costs are incurred in this phase. Growth phase, boss, sales are rising quickly. So when the sales rise, which cost will rise? Variable or fixed? Absolutely correct. Very good. Variable cost will also rise a lot. And although we have incurred substantial fixed cost in the beginning, in the introduction phase, still we will have more fixed cost added, like step up fixed cost. Because capacity increases, so fixed cost also increases. Maturity, now you have stable sales which are at high volume, profit at high volume, and here generally what we incur is variable cost, because stability is there. Entity will be there in this level for long. Declining, sales are declining. Now here again we will have a lot of fixed cost also incurred. Why? We will have decommissioning, dismantling that will take place, and variable cost will also be there because sales are there. So till the time you have sales, will have variable cost, and fixed cost will decline. Although fixed cost, because capacity will reduce, right? And although you will have some new fixed cost also being incurred with this dismantling and decommissioning. Okay, I hope I'm clear. Any questions? Okay, so here I have just given some tips and tricks for your life cycle costing, because when it is asked in exam, sometimes students still get confused and they say, ma'am, it's really confusing to know what will be included and what will not be included. So I have given a summary here just so that you are never ever forgetting what to include in life cycle costing and what not to include. Okay, so look here. When we are in the manufacturing setup, almost all the costs relating to development, design, setup, and before the production starts, these all costs takes place. Design, development, and the setup. Revenue is only there when the product is sold. Okay, so please see that in life cycle costing, unlike the traditional costing where we don't take designing and development cost of the product and we simply capitalize it, we don't take the cost of abandoning and disposing of the asset, which we again simply capitalize to the cost of the asset. We will include here. We will include here, remember it. So life cycle cost is basically taking full picture of cost. And with this, we take smarter decisions. What pricing to take, what margins to keep, and what cost to take. Okay? So summary of all the cost is there in front of you in the form of flowchart. Okay, let's have a quick look. 8 main categories are divided into. First is research and development, that is before introduction. And we have the cost here like design, like prototype creation, testing, and equipments for the manufacture. Then technical data will also be added here, like when we buy patents and rights, that also will be added here as a cost. Then the training cost, like operating training, skill updates, all the training costs, irrespective of the fact that it is doing a value addition or not, since they are going to be incurred, you will add it here. Then production related cost like manufacturing cost. then distribution related cost as well, like transportation cost, your logistics cost, material handling cost, marketing and advertising also, okay, like customer services that we are providing and the promotion expenses. Inventory cost, you keep inventory, right, in the warehouses, so that warehousing cost, the spare parts that you buy, those cost, okay, that's like a consumable that you are using, that cost. Then all the retirement and the disposal cost, like the dismantling cost, decommissioning cost, as well as end of life cost, like cleanup cost also, okay. So right from start till end, you can see that we have included all costs, right from research till the end, right? I hope this gives you clarity, this flow chart. But this is some key pointers that I want you to look. Very, very important. Okay, these key pointers. What are these key pointers? These key pointers are, some costs are one time, like design and prototype. They are one time cost. Some costs are regular or recurring, like maybe research cost, production cost, marketing cost. These are all regular and recurring. So remember, whether it's a one-time cost or a recurring cost, it will not matter in life cycle costing. You will add both. Okay, then life cycle costing can apply to customer, services, projects, and it is not just applicable to physical goods only, provided you can calculate the life cycle cost. The concern is that you should be able to provide the life cycle cost. We will do questions, guys, but let's understand more. See, there's so much more that we can understand. Look here. There are some costs that we commit even before the manufacturing starts. Some costs are committed even before the manufacturing starts. Which are those costs which are committed even before the manufacturing starts? Like planning and designing cost. We have discussed it, right? And which are the planning and the designing costs? Like product design, okay? Like research that we do, like the market analysis, like the development of prototypes, all will be in the planning and designing and development phase. Okay, and these fixed costs will be incurred. Okay, now please look here at my screen. Planning and designing phase, even when it starts, we commit the cost. That look, in planning and designing, this much cost will be incurred. In manufacturing, this much cost will be incurred. And even when a product is dismantled, this much cost will be incurred. All this is done even before a product goes for designing. So at the time of research phase only this is done. Like at the time of planning and designing, these fixed costs will be incurred. At the time of manufacturing and sales, we will have fixed costs like marketing, advertisement, fixed production and sales overheads, design updation, the redesigning cost. Variable cost will be like material cost, buying the components, getting the labor, doing the variable overheads, production and non-production, having the sales commissions, for example. Service and abandonment, boss, the product life is ending. Then also we'll have decommissioning and abandonment cost, disposal cost. All of this will be already discussed, already fixed as the committed cost before the start of the product. So the question comes in, ma'am, do we consider committed cost also in the life cycle costing? Of course, whether a cost is committed or not, if it is going to take place during the life cycle of a product, yes, it will be counted. Yes. Okay. So we will be considering these costs in the life cycle costing when we are doing for a product. Very good. I'm sure you all are with me. Very good. Now a quick question if you can answer. When will you have your fixed cost to be the maximum or major? At the time of introduction of a product or at the time of maybe growth phase, maturity phase, decline phase? Tell me quickly, when would you have most fixed cost? At the time of introduction, designing, growth, maturity, decline? Quickly put up in the chat box. Absolutely correct, Jamin. Very good. Yes, it will be very high in both introduction phase as well as designing phase. Because in designing phase, we are designing the product, right? So we would be incurring the fixed cost like product designing cost, development cost, prototype cost, market research cost and all. But when the product is to be introduced in the market, that time also we do heavily investment in fixed cost like marketing, like advertisements, sales promotions, buying new non-current assets and so on. Okay, so yes, absolutely correct. You'll have these major expenses of fixed cost in designing, development and introduction. And post that, which cost will be very high? Variable cost. Very good. Okay. So this is just a difference that I've just taken for looking into the traditional costing and the life cycle costing. Now guys, when we see here, traditional costing generally just looks at 1 year or at max 2 years to see the profits or to see the costings of a product, right? We do an accounting for only 1 year though. But life cycle costing says don't look at 1 year, don't look at the short run period, look at a larger period, which is the life cycle of a product. Focus here is only on manufacturing stage in traditional costing. In life cycle costing, we have focus on all stages, design, production, as well as disposal. Right? Now, generally, when we do accounting for P&L, that is for expense recognition in traditional accounting, we tend to ignore design cost, prototype cost, and even dismantling because we capitalize them all in the product cost. So effectively, they don't go to the cost of a product only because they all have been capitalized in the balance sheet. And the P&L overheads go to the costing of a product. So traditional costing ignores them. Look at it. Such an important pointer, right? Traditional costing ignores it, but life cycle costing considers it. Okay. So therefore, traditional costing generally helps us to derive profits only for a short run. But life cycle costing helps us to derive profits for a longer period. Correct? I hope you all are with me on this. Great. Now comes the very important question. And that question is, ma'am, okay, fine, we understand about the life cycle costing and we completely agree. Okay, so completely agree that we agree with this life cycle costing and that it covers everything, completely agree with it. But can we suggest some ways by which we can maximize the returns here? Think, what are the different ways by which we can maximize the returns? First and the foremost, the major chunk of your expenses are fixed cost. So can we think of a way by which we can modify it, redesign it to reduce the fixed cost? We all go for those redesigning, right? We all go for those updations. We all go for the changing of the product's design, the changing of the product's source materials. Okay, so now when we change those designs, when we change those change those sources, what is the aim? The aim is to reduce the cost. So as much as we can reduce our fixed cost, we can save a lot in the life cycle cost. So around 70 to 90% of the total cost is covered only in your designing, planning and introduction phase. Just think of the quantum of expenditure that is incurred. Okay, now, so it's the teams, design and production teams that have to work efficiently here. Okay, just allow me 1 minute. Sorry. Yes. Okay. Now I think let's continue. So what do we see, guys, here? We see that first step to maximize the return. And why are we discussing it? We are discussing it. It's only because you have to suggest these ways in your exam. You'll have a case study where you have to think and then you have to suggest it to the management, the ways that they can reduce their costings. Okay, so number one, reduce the substantial portion of the cost which is incurred in the planning, designing and introduction phase, around 70 to 90%. Second, which is the second? The second would be just when the company is ready with the product, introduce the product to the market. Because by the time we think, competitors come and grab the market. Okay, and then when the product is launched, if there is a delay, it loses money. I think the best example I can give you is whenever we all watch movies, right? So many times it has happened that a movie launch is announced and then it gets delayed by 2 weeks. In between, very two new movies get introduced and launched. Okay, and those two movies fortunately become blockbusters. So the movie's launch which was delayed, which otherwise would have become a blockbuster, loses its revenue because of the delay in entering into the market. And this happens in our product launching also. And that is why when a company is thinking to launch a product, they always try to make it quickly. As soon as they know that the news in the market is getting out, let's launch it before anybody else comes and grab that share. Okay, but not everybody becomes successful also. So a thoughtful research is to be done that when is the right time to launch the company's products. Okay, and it should be in a position where the products are absolutely tested complete. Got it? Now, so the second is minimizing the time to the market. Third, reducing the break-even time. Very, very important. So it is basically try to capitalize either by doing a market penetration or market skimming, that try to grab the market as soon as possible so that the break-even point, that is where your cost is equal to your profits. Okay, that point, if you want to reach, let's say after 2 years, try to reach it in early. Why? Because nowadays products have very low or life cycle, since we have such multiple competitors in the market. So let's try and give our best with the product, market it to the fullest, keeping in mind the cost though. So make sure that the product is able to achieve its break-even point much sooner than expected. We have had many companies that did the same thing and that actually achieved their break-even point much sooner than expected. We have the famous cosmetic brand Sugar Plum that they achieved this target. In fact, the various other players like Unacademy also that achieved its targets. And I think if we come to BB Virtuals also, and we are also line of achieving this target as well. So break-even point should be achieved as soon as possible so that the profitability gets maximized. Then line stays extending the product life cycle. People, quickly, do you all know about the Maruti Suzuki Swift? This car? Do you know about this car? I mean, that is, I think, or I say Hyundai i10. I want to talk about those basic cars that are there in this market for long. Do you know about them? Have you been hearing about them for like many years? Yes, absolutely. Okay, so I think since many years, Swift that was introduced in the market. Okay, I will take that example, Maruti Suzuki Swift, and it's still there in the market because it tried to remain in the market by extending the life cycle, by introducing every year a new variant. Likewise, so these cars like i10 and i20, because you have a lot of competitors of these cars in across the different brands, but they try to remain in the market with the new variants, new designs, something new all the time, so that the customer interest remains there. It doesn't get affected. It doesn't get lost. Right? I hope you all are absolutely with me. So stunning, so great. Very good. Okay, finally, I think now when we have discussed about the ways also to elevate our life cycle costings and elevate our life cycle of the product, maximizing the returns. So I think let's look at a quick summary of what are the benefits of life cycle costing. I think the major benefits of a life cycle costing is that it draws management's attention to all costs, some costs which are ignored in traditional costing like designing and the planning, the decommissioning and all. From the expenses point of view, they are even looked upon by the management. That means they will still look into the ways to control that cost, to optimize that cost also. It focuses on measuring a product's cost from start to end, which is the best way. Because see, when I am estimating the cost of the product from start to end, I kind of have a faith, have a relief. Okay, fine. If my cost is getting completely covered and then also I have a profit margin, then we are at the right position, and the sales that we are estimating, only those targets we need to meet. That's all. Okay, your work is half done. So now life cycle costing is not short-term oriented, correct? Because we look at the entire life cycle of a product. So it is long-term oriented, which is its major advantage. And therefore it helps management to make a well-planned and completely clarified, simplified and logical decisions, rather than just doing everything on the basis of just some budgeted projections. We have everything clear cut in picture in front of us based on the past experience and the future estimations, so that the management is in a position to make better decisions. Right? Now, lastly, can we apply life cycle costing in service industry? So yes, you will say, ma'am, we just discussed some while ago that yes, we can apply. I am saying we can apply, but it is very difficult to apply. See, because even in service industry, we spend a substantial portion at the beginning only. For example, I want to grab customers, right? So even I will do a lot of marketing, advertisement at the beginning only. So service industry also has a substantial expenditure incurred in the beginning. Let's take one more example, and I've taken a very interesting example of a bank. Okay, so when you want to take a loan, when you want to open a bank account, do you find that the bank people, they call you oftenly, they are, they entertain you a lot for getting that account opened? Have you ever experienced it? Do you receive those calls a lot? Please open the account with us. Please get a deposit done with us. Please get a loan from us. And if you show interest, they always call you frequently. Have you ever had this experience, guys? Did any of you ever had this experience? I don't think it's a very unusual experience. Okay, yes, I'm sure all of us have had it. Even you will say, ma'am, just now when you're teaching, I'm getting a call from the bank. Okay, they're asking me to take a loan, of course. So banks also spend a lot of money to get their customers and early on expenditure. After that, it's just their maintenance, that's all. So every service industry, they spend heavily at the start only. So yes, the life cycle costing can be applied there. Let's look at the example. For example, the following one-off cost might be incurred by a retail bank at the start of a new customer's life. Financial incentives, that is below market interest on borrowings for 12 months, incentive to attract the customer. Initial registration free of cost, validation of personal details, documentation, everything done at your home. Somebody will come from the bank and do it. So even you don't need to go out, right? It is the benefit that they are giving you. Credit worthiness checks. So we all have the CIBIL scores, right? That are checked by the banks to see whether the loans can be provided or not. Setting up the bank account access, issuing the IDs and the passwords, everything is done by the bank, and they do it for free of cost for you, right? But at the end of the bank, they are incurring charges, and which are heavy. So these are the one-time expenses that they do incur, right? Once the customer accounts have been set up, many of costs will not be incurred, and they will just have maintenance costs. So yes, we can have an estimation of services and also, but the only challenge are all services are different from each other. So then creating an estimation, and it also depends upon the person's life also, right? So survival rate and all. So all of these factors can make it a bit complex, but yes, we can have life cycle costing adopted for service industry as well. I hope we are clear. Any questions, any challenges, any doubts? Now is life cycle costing on your tips, people? Yes? Okay, let's look at the examples to be absolutely thorough with it. Okay, so now let's work out some questions. Okay, is there anyone who would like to work out questions along with me? So that I will give you 30 seconds to try out some questions. Okay, then I think everybody can try these questions with me. I will be solving it. Okay, so let me solve this. Now let's look at the first question, all of you. The first question is, Zenny developed a new computer game during the year 20x2 for $200,000. The game will be launched in the year 20x3, and development of the computer game has started in 20x2. The budgeted revenue and cost of the game over the life cycle is presented here. This is the revenue and this is the cost, all the cost. Calculate the life cycle cost per unit and profit per unit. So I think we can do it. Okay, so let's get the totals, and we need everything per unit. So first let's get the life cycle cost per unit. Okay, let's write here life cycle cost. Okay, life cycle cost will be equal to. Now what you will do, you will add everything from start to end. Okay, so let's add it. So let's keep on adding. Let's get the total cost. I will take the figures in thousands. 200. That is this cost of development. Okay, cost of development will also be added here. Plus, now take the entire cost. So we have here variable cost 30, 65 and 20. Let's add it. 30, 65, 20. Along with that, let's add the marketing cost 40, 30. Along with that, let's add the development cost, which is 200, which we have already added. So we have added the development cost, we have added the marketing cost, we have added the variable cost. Done. We have added all the cost. Now let's get the total. So we get total life cycle cost is 385,000. Now let's get the cost per unit. So I will write here. So life cycle cost per unit will be, you divide it by the number of units. Total number of units are given here, 16,000, 34,000, 12,000. So 16 plus 34 plus 12, which will be 34 plus 12 is 46 plus 16, 62. So let's get the cost per unit, which will be 385. Divided by 62. Right, so we get the cost per unit to be 6.21. Okay, 6.21. Now let's get the revenue per unit. What is the total revenue? Okay, what is the total revenue? It is given here. Now we'll take the figures in thousands. So total revenue is 160 plus 340 plus 120, which is incidentally, it shows it is 10 per unit, because this is exactly same. Yeah, so revenue is 10 per unit. Even without writing it, I can write 10. Now your revenue is 10, your cost is 6.2. Okay, so what is your profit per unit? Profit per unit will be 10 minus 6.21. Okay, so people, what is the profit per unit that we are getting? 3.79. So my profit per unit is 3.79 and my cost per unit is 6.21. Anybody who's not able to understand, please type it in the chat box quickly. Done? Okay, let's move forward and let's do activity 2. So let's do a few questions so that we have a good hold of this. Okay, the second question is also almost in lines with it, but there is no harm in practicing more. So let's practice here. Okay, Life cycle, Solaris specializes in the manufacture of solar panels. It is planning to introduce a new slimline solar panel specially designed for small houses. Development in the new panel is to begin shortly, and Solaris is in the process of determining the price of the panel. Okay, so we will have to determine the price. An expectation of the cost over year 1, year 2, year 3 and year 4 is given to you. Okay, now Marketing director is believing that customers will be prepared to pay 500 for a solar panel, but financial director believes this will not cover all the cost throughout the life cycle. So we will see whether it is covered or not. It is getting covered or not. Okay. Calculate the cost per unit looking at the whole life cycle and comment on the suggested price. So let's calculate the cost per unit. For that, first we will calculate life cycle cost total. Okay, what is the total life cycle? I'm sure guys you will be able to do it. So let's calculate. So we will have see here we have R&D cost, we have marketing cost, we have production cost, we have customer service cost, we have disposal cost. Add everything. So I will just start with the brackets and let's quickly add on. Right, so we will add here. Start from R&D cost 1900. If I take the figures in thousands, no, I'll take the full cost. Right, so we will have, okay, this is per unit production. As it is, we have to multiply. So let's take figures in thousands only. It will make it our life easier. Right, so I will have 1900. That is this cost, R&D cost. Okay, this cost, which is the cost of, okay, the cost of year 1. Then I will add cost of year 2. So I will do plus sign and I will write 100. Plus we will have the marketing cost, which is again 100. Say marketing cost for year 2 is 75. So quickly keep on adding 100, 75, 50, 50 and 10. Then let's add the production cost. We have to multiply. Don't forget it's per unit. 500 multiplied by 2000. So I can multiply 500 into 2000. So I'm taking, so I'll take 1000 for that. Plus 450 into 15. For that now I need to use the brackets. 450 multiplied by 15. Plus we will have 400 multiplied by 20. Plus, oh sorry, I needs to win the bracket. Okay, 400 multiplied by 20 plus 450 multiplied by 5. Okay, so now we are done with this. Now we will have, no, there are more costs, customer service cost also. So I will add here customer service cost, which is 50 into 2, which is 100. Okay, then I will add 40 into 15, 600. Right? You will say, ma'am, this much maths you know, right? I know this much calculations. Okay, then we have 40 multiplied by 20, 800. Right? Then I will have, again here 40 multiplied by 5, 200. Are there any further costs? Let me check further. Yes, we have the disposal cost also. So disposal cost is 300, that I will add figures in thousands. Now I can do the bracket close, and so the total life cycle cost that we are getting is 29660. Just let's check whether we have missed out on anything or not. Oh, wait, simple error. I've taken this, I've taken 175, 50, 10, 1000, this, done. Okay, so now my total life cycle cost is 22235. Now what is the question asking you to fix a selling price and whether it is being covered by 500 selling price or not. So what we need to do, we need to divide it by the number of units. So let's see the number of units and let's divide it. Number of units. Okay, let's see the number of units, people. Number of units are going to be, here it is 2000, 15,000, 17,000 plus 20,000, 37,000 plus 5,000, 42,000. Taking the figures in thousands, I will just take 42. Okay, now let's get cost per unit. So cost per unit will be now, just divide it. Okay, so you'll have 22235 divided by 42. Okay, now look here, whether the 500 claim of the marketing person is correct or not. That 500 will not be able to cover the life cycle cost. Let's check it. So what is the answer that I'm getting, boss? It's 529. So yes, marketing director is absolutely correct that the life cycle cost will not be covered by 500 selling price. Hence, the pricing should be changed and the price should be fixed at a higher level. Right, I hope I'm clear. Any questions, any doubts, please put up in the chat box, all of you. Right, everybody is with me here. Jamin, are you clear? Others, are you clear? For any questions, please type it in the chat box. Quickly tell me or revert. Okay, let's move forward and let's do more questions here. So I have two more questions. Let's discuss them. Just give me 1 minute. Okay, let's do these two questions. Now, they are very, very, very easy questions. So let's have the answers. When are, I'm sure now this you will be able to do it because we have done it in the theory part. So let's see how many of you can see in the practical part. Okay, when are the bulk of a product's life cycle cost, okay, usually determined? When are they determined? Okay, let's have answers. At the design or the development stage, when the product is introduced to the market, when the product is in the growth stage, or on disposal. 10 seconds to everyone. Let's see who can answer. Do I have answers? Okay, which is the correct answer that we have decided? Where is the major cost incurred? Absolutely correct. Design and development phase. Yes. So the answer here is design and development phase. Okay, absolutely correct. Let's go to the next one. Which of the following items would be included in the calculation of, very good Jemin, in the calculation of the life cycle cost of a product? Which of the cost would be included? Planning and concept design cost, preliminary and detailed design cost, testing cost, production cost, distribution and customer service cost, and accordingly the combinations are given. Again 10 seconds. Let's see who can answer. 1, 2, 3, 4, 5, 6, 7, 8, Yes, very good. All cost. As I told you, in life cycle cost, all costs are included. So now we are done with life cycle costing. Any questions, any doubts, please put up in the chat box. Very good, Sahitya. Correct. Perfect. Very good. Okay, and now we are going to start with a next chapter, a next topic, throughput. Guys, all of you looking for breaks, I'll give you break in 30 minutes once we cover throughput. Okay, very interesting because post break we will do CVP analysis. Okay, very good, Jamin. You're also correct. Very good. Okay, let's start with throughput. What is throughput? Okay, have you heard terms like this? We have heard terms like profit. We have heard terms like contribution. We had heard terms like throughput, or we are going to be hearing about throughput. Okay, now quickly, what is profit? How do you calculate it? Sales less all cost. Here, contribution is sales less variable cost. Throughput is sales less only material cost. Okay, so this is basically what is throughput about. So throughput is just like a profit, just like contribution, just that we are focusing on a different kind of benchmark, a different kind of, yardstick, a yard scale to measure our performance. That is throughput. Okay, I hope all you are with me. So now you will say, ma'am, why do we have throughput in place? See, when the economists, they formulated this throughput formula, they were not wrong, because what they said was, you have hired a staff, right? Suppose, let's say I have 10 people in my organization. Okay, I pay them salaries. So if I talk about a month, okay, let's say that if I talk about short run, unless they have a chances to leave for 6 months, even the direct labor cost, which is actually on the shop floor doing the manufacturing, they are acting like fixed. You will say, ma'am, why are you saying it? See, because I have to pay them this amount, a fixed amount, a minimum amount, I have to pay them. So we don't see really a lot of behavioral change there. But what gets changed is only material cost. If I'm not manufacturing, if I'm doing less manufacturing, also I will do less materials. But the labors, I will have to bear them, because there is a minimum pay that I have to give them, whether I make 1 unit or I make 100 units. So throughput accounting goes with a background concept that simply says that even if the labor is not working, you have to pay them that salary. You have to pay them those wages. So then labor generally acts in the short run in the fixed way. So the only variable component then you have is material cost. Okay, so the only variable component then we have is only material cost. So the economists suggested, then why do you want to maximize contribution in the short run? In the long run, go for it, absolutely okay. But in the short run, then this is not the correct way. So then the question comes in, ma'am, what is the correct way? How should we do the maximization? Because ultimately the organization's aim is to maximize profits. So now if I know my direct labor is fixed, if I know my production overhead is fixed, then what is variable is only material. So throughput accounting says the only material item that you have, or the only material expense, the only variable expense that you have is material cost. So organization should aim to maximize throughput, that is maximize sales less variable cost. If you maximize this gap, then you would be able to earn the profits here. So you would say, ma'am, then what do we call this? Direct material plus production overheads. We call them together as operating expenses. Or we also call it as factory overheads. That means these are those expenses that are going to remain fixed and they are incurred for the factory. Direct material here is fixed as well as the other production overheads. So they would be treated fixed as an operating expense or a factory overhead. And what is going to vary is only material cost. So organization should aim for maximizing the throughput, and in fact if you have multiple products, you should try to maximize that product first, or to maximize the production of that product first. That is maximum throughput. Maximum throughput means maximum coverage of expenses, so maximum profits. Everything is max. Okay, clear? So now here we have understood the concept of throughput, and the entire chapter is all about this. That's all. Let's go into the topic, then I will take more. So the economists Goldratt and Cox, they suggested this. Now one more concept of throughput. Bottleneck. Okay, so one more concept of throughput is bottleneck. Let's take an example. Okay, I want to print my book. So in my printing of the book, I have got 4 stages. So I want to print my book. Okay, now in this book, I will have 4 stages. Okay, now in one day, I can write, let's say in 1 week, I can write 70 pages. My editor will be able to edit 60 pages. No, my editor has a capacity to edit 100 pages in the week. After editor, it goes to a reviewer. My reviewer is able to review 90 pages in a week. Okay. Now finally it goes to publisher. And publisher is already full with lot of books. So he says that okay, at max I can publish 110 pages in a week. Now my question to all of you, those who are there in the class, and I want you to type it in the chat box. What do you think can be the maximum output of the week? Can it be 70 pages? Will it be 100 pages? Will it be 90 pages? Or will it be 110 pages? What is the maximum output that I can have a week? But remember, every page will go through these 4 steps. First, writer, then editor, then reviewer, and then publisher. So what do you think? How many pages at max can be published by the publisher for the week? I want you to quickly put it in the chat box and give me the answer. Okay? 10 seconds only. 1, 2, 3, 4. You'll say, ma'am, your fingers are moving faster than the second hands also in the clock. Okay. 5, 6, 7, 8, 9, 10. Absolutely correct. You will say, ma'am, if the product has to go through all these 4 steps, then the pages can be, maximum output here would be 70. And this 70 will go for edit. Editor has a capacity for 70, he can edit it. Reviewer also has a capacity to review 90 pages, he can definitely review 70 pages. No Gemin. So look at this approach. Okay, but the publisher even though has a capacity of 110 pages, but what he is getting from the reviewer is only 70 pages. So how can he publish 110? So he would also publish 70 pages only. Gemin, my friend, are you clear? No need to erase that options. Even if they're wrong, that's correct. I mean, that's okay. Are you clear, my friend, till this point? Okay, so what do you observe here? Just because the writer has low capacity to write, the editor, even though he has higher capacity to edit, reviewer, even though he has higher capacity to review, and publisher, even though he has higher capacity to publish, they are not able to meet their capacity because there is a hindrance here. And this hindrance is writer. So I will call this writer as bottleneck. And why do I call him as a bottleneck? Because he's hindering, he is limiting everybody else's capacity. Clear? Now let's look at one more question. So now I'm taking an example here. A factory makes 3 products, all of which pass through 3 machines. Time spent on each machine is the same for all 3 products. Just see, time spent on each machine is same for all the 3 products. Now, look here now. Okay, demand for the company's products exceeds the amount that the company can produce. Okay, the maximum daily output of the 3 machines is as follows. Machine 1 can have a maximum daily output of 200 units. Machine 2 can have a maximum daily output of 180 units. And maximum machine 3 which can have a maximum output of 210 units. So going by this example, very good Sahitya, you are correct. Going by the previous example that we discussed to understand the concept, now we know that machine 2 is the bottleneck. Why? Because even if machine 1 is manufacturing 200 units, output from machine 2 can only be 180 units only. So even though machine 3 can have 210 units as the output, but we cannot finalize this product. So now machine 2 is the limiting their capacity of everybody's for the total production, and hence the company can only have a total production of 180 units. I hope this is absolutely crystal clear, 100% clarity with all those who are attending the session line. Do type it in the chat box so that even I know that you are following or not. All the viewers, those who are viewing the video right now, type it in the chat box. Okay, you're wrong or right, doesn't matter. I will correct you. You ask me million queries, I will answer it. But let's have absolutely 100% clarity on it. Okay, so very good. Now the question comes in, ma'am, what to do now? Right now we know it is a bottleneck. So now what should be done? You tell me what to do. You will say, ma'am, why don't we increase the capacity of machine 2? Absolutely. Let's do it. So I say that now let's reframe it like this. That let's have machine 1 at 200 units. Machine 2, let's say I increase it to 250 units. Okay, and machine 3, I will increase it to 200. No, I'm not increasing. Sorry, it is same at 210 units. Okay. Now, what do you observe here? Machine 2 capacity is increased. So now machine 1, same pointer, same sequence. Machine 1 Okay, now my question. So now if I elevate the bottleneck, listen to my terms. If I elevate the bottleneck, machine 2 is now making the output of 200 units. Machine 1 is making the output of 200 units. Machine 2 is making the output of 250 units. Machine 3 is making the output of 210 units. Now again, let's see the sequence. So machine 1 will be able to make 200 units. Machine 2 will be able to make 250, but it is getting an input of 200 only from machine 1. So it will make 200 units. The same 200 it will send to machine 3, 200. So even though machine 3 has the capacity of 210 units, but still it would only process 200 units. Because that is what it is getting from back end, correct? So now what do you see here? In the last case, just sometime back, we had machine 2 as the bottleneck. Now machine 1 is the bottleneck. So what do you observe here? First, you will always have one bottleneck, always. If machines get elevated, so maybe time becomes bottleneck, maybe the production becomes bottleneck, maybe any other factor like raw material becomes bottleneck, direct labor time becomes bottleneck. So remember that always we will have one bottleneck, always. Okay? So when one bottleneck is elevated, another thing becomes a bottleneck. So that is a continuous circle that will always take place like this. Now another point, that is a point of observation. Now, though none of you said, but what if I had kept machine 2 at 180 only and I had increased this to 250? Understand? What if I increase machine 3 to 300? Will it matter if I elevate the non-bottlenecks? No. Why? Because 250, I've increased capacity for machine 1, but when it is sending units to machine 2, output is only 180. So machine 3 in all the cases would be only able to process 180 only. So remember this as a very important 2 marks question point, that elevation of non-bottlenecks will never add anything to the bottleneck capacity. It's only the bottleneck that should be elevated in order to improve the capacity. However, when one bottleneck is elevated, another bottleneck gets created. So I hope you all are there with me on this. Any doubts, any queries, put up in the chat box. So let's look at the steps in detail and then I will just take up more pointers. Okay? Now, just look at the steps, and this is also known as theory of constraints, and this term was given by Goldratt and Cox, and they defined it as theory of constraints. So in your exam, you can have throughput accounting, you have theory of constraints, one and the same thing. Bottleneck and constraints are same. Okay, but whenever it's a throughput question, you will always have bottleneck term. So look for that term or look for a constraint term. Okay, so that you know that you have to solve this question from throughput point of view. Clear? Now what are the steps? Identify the system's bottleneck. Decide how to explode the bottleneck to the fullest. So use to the fullest the capacity. Subordinate everything else to the decision in step 2. That means make sure that you're utilizing the full capacity of the bottleneck. Elevate the system's bottleneck, and now something else will become bottleneck. Are we crystal clear till this point? Any questions? Please ask me. Now we know the difference between traditional accounting and throughput. Again, I put it here. The only reason I'm giving you differences here is so that, guys, whenever you see a question, these pointers will help you to write theory questions. Okay. Now, traditional costing considers labor and material both as variable cost, even variable overheads also. Okay, but throughput accounting says only material cost is the variable cost. Rest all costs are non-variable in the short run. Now, inventory will be valued at total production cost in accounting, traditional accounting. In throughput accounting, since our only variable cost is material, so inventory will only be valued at material cost. Value is added when an item is produced. Here you will have a value addition when an item is sold, because from throughput we look at the output point of view and not input point of view. Major difference. Product profitability is defined by determining the total cost from selling price, but in throughput the aim is to maximize throughput. Okay? And here we define the profitability at the rate at which the money is earned. That is the rate of throughput earning capacity. Okay. Any doubts, any queries? Now we go to the last portion of this, which is throughput accounting ratio. We call it as, in short, TPAR. Throughput accounting ratio. Okay, throughput accounting ratio is basically, we use this ratio to basically, rank the products. Suppose there are multiple products and we need to know the products will be manufactured in what sequence. So then we use TPAR to help it here. Now, but just remember it. TPAR also helps us to analyze how a product is performing. Whether the product is having more cost than the returns or is returns more than the cost. Okay, so for that we have TPAR, throughput accounting ratio. What is the formula? The formula is simple. You will have a proportion of returns divided by cost. Okay, now this formula is, I've written it very clearly. You have to learn. There is no other option rather than learning. This will not be there in your formula chart given to you in the exam. So guys, do learn it. It's not difficult. When you do questions, it will be memorized in your heads. Logically, let's understand. What is the total factory cost? We already know about it. We have discussed in our notes. That is fixed production cost including labor. Understand. When we do throughput, we are only doing it from production cost point of view. So throughput will not have any non-production cost. Very important exam point of view point that I want to highlight here. Other fixed factory cost that do not, the factory cost will never include administration cost or marketing cost. If they are mentioned in the question, you are going to ignore it. You will not take into account non-production cost. Remember it. Throughput we only calculate with respect to production cost. So the factory cost only includes production cost. And if this is given in the question to confuse you, ignore marketing, ignore administration, ignore selling, distribution, all of them. So factory cost, or we also call it as the conversion cost or operating expense, it is simply equal to all the cost less material cost, like direct material and production overheads. So what is the formula? First step, we know now factory cost. Second step, calculate return per factory hour. Return per factory hour. Return here is throughput. Throughput divided by bottleneck time. So what is the total available bottleneck hours? You will divide by this. So this we also known as throughput okay, that we also know as throughput per factory hour. Okay, so quickly if I say the formulas, so what is TPAR? TPAR is throughput divided by bottleneck hours. So throughput per hour we will get it. Okay, so now just a minute. So we have the throughput and we divide it by the total number of bottleneck hours and we will get our desired return per factory hour. Okay, so this will give me, this is not TPR. This is the first step that I'm doing. So this will give me return per hour. Okay, so I will take bottleneck hour per unit. And here I will take throughput per unit. Right, so this will give me return per hour. Okay, now the next point is, how would you calculate the cost per hour? Cost per hour is, we have calculated the total factory cost divided by total hours. Now when you know got cost per hour, because this is total, right? Factory cost is total. So total factory cost by total hours. You will get cost per hour. Return per hour here is, you have throughput per unit, you divide it by the bottleneck hours per unit. So you will get throughput per hour, return per hour. Now TPAR is simple. That says return per hour divided by cost per hour. Okay, so it says that return per hour divided by cost per hour. Okay, any questions till this point? Okay, so again I repeat, it is throughput per unit divided by bottleneck hour per unit. Cost per hour is total factory cost by total bottleneck hours. And we will always do it with respect to bottleneck only, because the purpose is to elevate. Okay, and then we see TPAR, which is throughput accounting ratio, and which is return per hour that you have calculated from step 1 divided by cost per hour that you have calculated from step 2. So this is coming from step 1 and this is coming from step 2. Right, I hope I'm clear on this. Everybody, any questions, any queries, put it here. I hope that my Excel gets opened. So thankfully it has got opened. Now quickly let me just reopen it. And so that we do more questions, just few more pointers and we will do more questions about it. I think in the meantime, I can just quickly solve one question here in the notes till the time that it is getting opened. So let me just write down one question for all of you because I remember it. So I think we can write down. Let's take a random question. Okay, so that is TPAR calculation. Okay, let's have an example here. So that question is, let's say, product 1 requires 4 machine hours and machine time is the bottleneck. I'm telling you that information here. Okay, machine time is the bottleneck and total available machine hours are 650 hours. Okay, this is the total available machine hours. Now, selling price is equal to 120 per unit. Material cost is equal to 35 per unit. Other factory cost are equal to 13,000. Okay, calculate the TPAR. So let's do the calculation of TPAR. For TPAR calculation, first I need to calculate what is return per hour. What is return per hour? For that I need throughput. Throughput will be selling price less material cost. So it will be 120 less 35. And we always do it throughput per unit. So I repeat the formula here. Throughput per unit divided by bottleneck time per unit. Throughput per unit will be 120 less 35 divided by the bottleneck time is per unit is, so here it is given 1 unit requires 4 machine hours. So my bottleneck time is 4 because this is the bottleneck. So my answer would be 120 minus 35 is, let me just do it on the calculators. 120 less 35 and divided by 4. So I get 21.25. Okay, now let's do the next one, which is cost per hour. Cost per hour will be total other factory costs are 13,000 divided by total number of hours bottleneck are 650 given to you here. So I will take 650. So my cost per hour will be, again I'll just use the calculators, which is 13,000 divided by 650. The answer is 20. Okay, so now I got this as 20, this as 21.25. So what is my TPAR? TPAR will be 21.25 divided by 20, which is again equal to 1.0625. Okay, I hope the calculations are absolutely clear. If you're stuck, then please tell me. Okay. Now let's do the interpretation. So we have done the calculation. Now we know absolutely clearly that my throughput in the example is more than 1. What does this imply? What does this imply if your throughput is more than 1? What does it imply? So let's do interpretation. This is highly important when you're writing your answer, especially the section C question. Interpretation is important. Section A and B, hot favorite topic for interpretation. Question will give you a scenario. Interpretations you will have to do and choose the correct option. So let's have the complete understanding of the same. See, if the TPAR is more than 1, what does it mean? Your returns are more than the cost. So that means the product is profitable. If your TPR is equal to 1, returns is equal to cost, break even. If your TPR is less than 1, then boss, don't go for this, because your costings are more, returns are less. So it is a loss making product, and here your contributions, your throughput is not able to cover the cost. So as it is, your fixed costs are more, and we should try to go for cost cutting. So then comes the question, ma'am, what if my TPR is less? How to improve it? First, improve your throughput, improve the numerator. That is, either you reduce the material cost or increase the selling price. Second, elevate the bottleneck. So elevation of bottleneck will also help you to reduce it. Third, reduce the total cost of the factory, that is the fixed cost, right? Or elevate the bottleneck, the total hours. So this way we can definitely improve our ratios. Although we don't recommend selling price as infeasible measure. If this is given to you in your exams, in the options, don't opt for it, because selling price reduction is generally market driven. So it is not a decision that the company should take, and it is not feasible, because in the long run then the company will have to suffer, right? So it's better not to go for it. I hope I'm clear. Everybody, I hope I'm clear on it. Any doubts here, Sahitya, Jamin, and all those who are there in the live session? Okay, let's look at more questions now. Okay, so we have discussed. Let's do the first one. Very interesting. Okay, the first one is the company passes its products through 4 production processes and is currently operating at optimal capacity. The following data is available: loading, washing, drying, labeling. Time per unit is given to you. Total machine hours available are given to you. Which process is the bottleneck? So what to do? Get the total time. Loading has got the total time of okay, this is hours. Okay, so 80 hours. We need to 800 hours. We need to first convert it into minutes. So because the answer is in minutes, time per unit is in minutes, right? So 800 multiplied by 60, 48,000. 48,000. Let's see what is the maximum capacity that they can make. See, ultimately, bottleneck is the one that is making lower units. So here I will have 800 multiplied by 60 divided by 3, because a unit requires 3 minutes to make. So total the company can manufacture in this case is 16,000. In the second case, it can go for a manufacturing of 1,000 multiplied by 60 divided by 6. So in the second case, a manufacturing of 10,000 can take place. In the third case, 1.5 multiplied by 450 multiplied by 60, we get the total minutes available, and this divided by 1.5, because 1 unit requires 1.5 minutes to make. 1800. 1800, it should be 1000, no? Yeah, 450. Okay, because everything is in bigger numbers, right? And here we have 450 units, and each unit requires 2 minutes. So we have 13,500. 13,500 units. Now, which of these is the lowest units? Product second one. That means washing. So my correct answer here would be that washing is the bottleneck, because it is having the lowest capacity to manufacture. So I would go ahead with washing. Am I clear? Any doubts? Any questions till this point? All of you, quickly. Okay, then let's go further and discuss the next question. We have done the next one. third question. But before third, I think I would like to do this question first. It's a theory question because many times in PM, I keep listening from students, hearing from them, ma'am, theory was a heart attack. I was not able to do theory. Now with your concepts clear, let's see if you're not able to do it. Okay, let's see it here. So now quickly. In the theory of constraints and throughput accounting, which three of the following actions may be used to improve TPAR? Which of the three ideally that we can take? Okay, increasing selling price, yes, but right now let me see the other options. Decreasing selling price, definitely not, because when you decrease the selling price, your return will reduce. Buying cheaper materials, no, it is going to affect your quality. But let's see the other options. Though by cheaper material will mean lower material cost, so it will mean a higher return. Okay, reduce time per unit spent on the bottleneck machine, absolutely correct. Increase time per unit, no. So I think yes, we have to go ahead with this only. These are the other two feasible answers, because when we increase selling price, my throughput return increases, and when we reduce the material cost, my cost reduces. Okay, now let's go to the next one. First, I will take this thing. Okay, and people, after this, I'll give you a break before we resume for CVP. Now, MN Company manufactures automated industrial trolleys. Each trolley sells for 2,000 and the material cost per unit is 600. Is 600. Labor and variable overheads. Okay, labor and variable overheads. It's a very interesting question. Be with me here. Labor and material overheads are 5,500 and 8,000, which is the fixed overhead, fixed factory cost, right? That we take as factory cost per week respectively. So this is the selling price, material cost, factory cost. Fixed production costs are 4,50,000 for a year, and marketing and administrating costs are 2,65,000 for a year. You know that you will not take into account 2,65,000, but 4,50,000 is for a year that we need to convert to a week. The trolleys are made on three different machines. Machine X makes the 4 frame panels required for each trolley. Its maximum output is 180 panel per week. Machine X is old and unreliable and breaks down from time to time. It is estimated that 20 hours of production are lost. Very good question. Loss is also there in time. Okay, are lost per month. So machine Y can manufacture, but remember we are doing everything by a week. So I need to convert it into week. Okay. Now, let's see. Machine Y can manufacture parts for 52 trolleys per week, and machine Z, which is old but reasonably reliable, can manufacture up to 30 trolleys. So it can make 30 trolleys, it can make 52 trolleys, it can make 180 divided by 4. 180 divided by 4, this much trolleys it can make. Now, the company has recently introduced just-in-time system, because throughput is more better when we have just-in-time system in place. Okay, the reason being your inventory cost is minimal, right? Your holding cost is minimal, so you'll have maximum throughput contribution available to cover your fixed cost, to cover your factory cost, right? Now, is company's policy to hold little work in progress and no finished inventory from week. The company operates a 40-week or 48 weeks a year. That means 40-hour week and 48 weeks. That means 4 weeks in a month. So if my loss is 20 hours in a month, that's roughly around 5 hours in a week. Right? That's roughly around 5 hours in a week. So now, I need to know what is the maximum output that we can have from machine X and Y and Z. Y is clear, 52. Okay, for Y, let's say for X, just 1 minute. Right? So let's say that machine X, we have to do it for machine X, machine Y and machine Z. See, machine Y and Z output are very clearly given to us, which is given here 52 and 30. So that I can use directly. Only question is for X because there is a loss here. Now just see, overall 20 hours will be lost in a month. So 5 hours will be lost in a week. 5 hours lost means how much you are losing on the frame. Okay, so let's take that percentage. So the loss is around, let's take the percentage, 5 hours loss in a week, right? Right now it is making how many trolleys? Right now it is making 180 divided by 4, which is equal to, let me just calculate. Okay, here only I can do. Right now it is making 180 divided by 4, which is equal to, oh, I'm sorry. Okay, which is equal to 45 trolleys. But it is losing, right now it is making 45 trolleys without loss, But the question says that the maximum output is 180 frames per week and it makes 4 panels required for each trolley. So it is just making 45 trolleys if it is not having any loss. But it is having a breakdown of 5 hours. 5 hours would mean that how much is losing. So let's take the percentage. Okay, let's take the percentage of the loss that it is having, right? Of the loss that it is having. So you can say that the question gives you that there are total 40 hours in a week. Out of the 40 hours, he is losing 5 hours, right? He's losing 5 hours. So how much loss he's having? He's having a loss of 5 divided by 40 multiplied by 100. So there is a loss of 12.5%. So that means my production will also be reduced by 12.5% because in a 40-hour regular week, we would have made 45 units. But now we have a 5-hour loss, that is approximately around 12.5% loss. So what would be the effect? That let's calculate. So the effect would be that now the entity would be able to manufacture 45 multiplied by 100 minus 12.5. Oh, it's underscore. So the entity would only be able to manufacture now approximate 39 trolleys. Why? Because there is a reduction of time by 12.5%, right? Or even you can also solve it this way, which is also one of the easier way. 45 is the production when we have 40 hours. So what would be the production if I have 35 hours? So that will be 39.35. You will get the same answer. So anyways, which way you are convenient, you can do it. Either by using the percentage method or by doing it in this way like we have just done. Okay, so in any case, in any ways, you can do it whichever is more convenient to all of you. For any queries and questions, you can put it in the chat box. Yes, Sahitya, you've been correct. Sorry, I could not revert to you that time. Okay, yes. So any questions? Are you clear, Sahitya, Jamin, all of the others who are viewing it? Any questions and doubts, please put up. So here, do I have the option? Yes. So now just see here. My X is 39 approximate because trolleys will be made in always wrong numbers. They cannot be do it in decimals. So which is the lowest? Z. So which is the bottleneck here? Bottleneck is not X that you may have been thinking. Bottleneck is Z. Machinery, Z is the bottleneck. Let's go further. And what is the TPAR? Let's calculate the TPAR ratio here. So here you will see whether the production overheads come in or the non-production also comes in. Okay. So for that, for TPAR, let's quickly do it here. So TPAR, when I work it out, I need two things. I need return per hour and I need cost per hour. So let's calculate return per hour, which will be equal to your throughput per unit divided by the bottleneck time. Bottleneck time is Z. Remember, bottleneck is Z. Okay. So let's get the return per hour. So what is the throughput? The throughput here is, see, I've got total trolleys of Z, which is 30 trolleys given to me. Right. So I think then we would be needing it in this way. So let me just work it out here. Okay, now let's see what is the throughput. Throughput will be selling price is 2000 less 600, right? 2000 less 600. Now what I don't know is how many trolleys are being made per hour. So we can calculate it 30 divided by 40, right? 30 divided by 40. So here we know that throughput per unit is 2000 less 600, which is 1400, divided by 30 divided by 40, and I will know my throughput per hour because 30 trolleys are made in 40 hours. So what is the time taken by one trolley? We can calculate it. So what is the throughput here? Let's look at the formula. Okay, I'll do it on the calculators. Okay, I will do it on the calculator. So I get here, just a minute, 1400 divided by 30 divided by 40, right? Because I will get what are the trolleys made in an hour. So I get this as this also got stuck. There are 30 trolleys made in an hour. So I get this as 1866. Okay, wait, I can do it here. Equal to my throughput is 2000 less 600, which is 1400. I need to get what is the throughput per hour, right? Per hour. Where's the bracket? 1400. No, actually it should be if I multiply it with 30. I will get the total throughput and then I will divide it by 40. This would be the appropriate way. So I will get 1050, not this one. Okay, I will just write it. See what is the most appropriate way, because when I'm reading it, I think we can see this here. Right, when you read it, look here. When we read it here, we find that each trolley is selling for 1400. So throughput per unit is 1400. We multiply it with the number of trolleys, 30, to get the total throughput. Then we divide it by 40 to get the throughput per hour. Right, so this is how we can do it. So I think it's more easy way to do it, right? So we will have here 2000 less 600, which is throughput per unit, multiplied by 30, that is for the number of trolleys of a bottleneck resource, and this all divided by 40 to get the total number of to get the throughput per return. So return per hour, okay? Now return per hour I'm getting is 1050, correct? Now let's go to the second point. I need to know what is my cost per hour. I want you to focus here, everyone, because now it is important to see which cost we will take. One cost is very clear, 5500 plus 8000. Another cost is also clear, 4,50,000 in a year, which we will divide by 48 to get the cost per week. Now the next question is, will I take 2,65,000? No. Why? Because it is not a production related cost. So what is my cost per hour in brackets? Let me work out. It is 5500 plus 8000. This is the cost per week. And plus, let's take the annual cost and divide it by per week. 4,50,000 and this divided by 48. So I get my total cost, which is 22875. Now I want to get the cost per hour. So how will I do it? You divide it by 40, same way to get the cost per hour. Right? So here my cost per hour will be 22875 divided by 40. No. No one. Oh, it's 572, 40 hours only. I thought it's 48 hours. No, it's 40 hours only. It's 572. So we got the cost per hour. Now let's calculate TPAR. TPAR will be 1050 divided by it was 572. So my TPAR is coming out to be okay guys, my TPR is coming out to be 1.83. Is it more than 1? Yes. Is it a good return? Yes. So now we know that since TPAR is more than 1, we know that it's a good return. So now the entity is doing good here, and this throughput we are earning good returns even though we have a bottleneck. So TPAR is showing me this, that even though we have a bottleneck, but still the company is doing good, the product is doing good, and the entity is still able to earn returns. So no need to elevate the bottlenecks, no need to elevate the TPAR, though we can adopt strategies, but as it is, the TPAR looks very sound and very strong. Okay, so good. I hope everybody has got hold of it. Now just one pointer before we go to a break. Okay, before we go for a break, or I say that let's have a break. Let's have a break and then we will continue with one more question of throughput before we take up a quick walk through the CVP. Okay, so let's have a break of 10 minutes. Don't go anywhere. Be there after the break. Hello everyone, welcome back. And now I'm sure that so far the topics that we have covered, like life cycle costing and throughput accounting, you guys are absolutely 100% crystal clear for it. And now any question that may come up and that you have to face in the exam, I'm sure you're going to face it with confidence. Okay, let's move further. Just one more question that I want to take up from throughput is the ranking of the products. Okay, so let's look at this question quickly. A factory produces two products, A and B. Both products pass through three processes, process 1, 2 and 3. Process 2 has been identified as the bottleneck. Already given to you in the question, process 2 is bottleneck. There are 10 hours of process 2 time available per day. Information relating to the two products are given: product A, product B, selling price, direct material cost, direct labor, traditional contribution, and maximum demand per day, as well as the time on process 2, which is the bottleneck time. Determine the daily production plan that would maximize the contribution. So the aim is to maximize contribution. How would you do it? How would you do it? How would you know which product should be made most? Product A or product B? So what are the steps that we should be following? So look at my screen, guys. And now let's look at and complete this question. Okay. So now I would just put up here what is a step 1 that you will be doing. Step 1 is calculate throughput per unit for both the products. So let's do it for product A and product B. What is the throughput per unit for product A? 100 minus 70, because we will take selling price less material cost per unit. 100 minus 70 is 30. I will write here throughput per unit 30. What is throughput per unit for B? It is 20. Clear? Now go to step 2. Step 2 says calculate throughput okay. Step 2 says, calculate throughput per bottleneck resource. You know what is the bottleneck resource here? Process 2. Very good. So now the formula that you have used, throughput per unit, and now you know here that bottleneck time is given to you. Hours per unit is 1 year and 0.5. So you can divide it and get throughput per hour. Okay. Again, I will list on A and B, and I will write here throughput per bottleneck hour. Okay, my friends, I'm sure you're getting all this. So we get throughput per bottleneck hour. And what is the throughput per bottleneck hour? Here it is 30 divided by 1, which is 30. Okay, then it is 20 that you have got here for B, throughput per unit, divided by 0.5, which is 40. 20 divided by 0.5 is 40, correct? So now you've got here. Now third step is, so I will write here step 3. Step 3 is ranking. Rank the products as per maximum throughput. Okay, so please rank the products as per maximum throughput. So now, which is rank 1? When we say throughput per bottleneck hour, you will always see step 1, step 2 to rank. You will never do step 1 to rank. Remember it. You will always do step 2 to rank. Okay. So which is the bottleneck throughput per hour? Throughput per hour here would be, first rank is product B and second rank is product A. Why? because product B is giving us the highest highest throughput per bottleneck hour, which is 40, and product A is giving us lower than this, right? Lower than this. So therefore, I would rank product A as number 2 and product B as number 1. Right? Now I hope we are clear absolutely till this point. Now you know the ranking 1 of the product will be made the most. So how many units we can make? We have ranked product B as number 1. Product B maximum units we can make is 14 units. And each unit requires 0.5 of the process hours. Process 2 hours, right? How many hours do we have? Total we have only 10 hours. Here the question gives me the total we have only 10 hours maximum. So how much hours we can use here? Let's see. So I will write here product A and B and we are calculating the profitability. Right? The question says the plan, sorry. We have to make the plan. Let's make the production plan. Product A will require 0.5 hours of process 2 and total units to make is 14. So each unit will require 0.5 hours. Total hours they require is 7 hours. Product B will require 1 hour and total they can make 8 units. 8 into 1 is 8 hours. 8 plus 7 is 15, but we don't have 15 hours. So how much we can give hours to product B? I'm sorry, this is product B. I'll just correct it. Okay, how much we can make for product B? We can make 14 units full because it is giving us the maximum throughput. So remember people, the first ranking product should be always made in full, 100% to the fullest capacity. So we are going to make full 14 units. Each unit requires 0.5 hours of process 2. So total time that we can give to product B is 7 hours. Total here is 10 hours availability. So remaining 3 hours can only be given to product A. Clear? Because it is a bottleneck. We cannot increase beyond 10. So how many units we can make for product A? Each unit requires 1 hour. It is given here. So we can only make 3 units of product A. Okay. Now what is this is the next step that we can do. So what is the maximum throughput contribution that we can have here? 14 units multiplied by, guys, we have calculated what is the throughput per unit of B, 20. So 14 multiplied by 20 is 280. Yeah, 280. This is for product B. For product A, it will be 3 units multiplied by 30. 30 is the throughput per unit. We get 90. So total we get maximum is 350. That means this is the maximum throughput that we can have. This is the maximum throughput contribution for product A and B given the bottleneck process 2. I repeat again, whenever you have to see the production plan, you will always do the ranking as per the throughput per hour. Step 1, calculate throughput per unit. Step 2, calculate the throughput per bottleneck hour. Rank the products and the product with the highest ranking, make it in full to the fullest capacity. Then the next ranking and so on. Okay? I hope it is absolutely clear. Now you guys are 100% crystal clear for your throughput and for your life cycle costing. Okay, let's move on and let's discuss the third one, which is CVP analysis. Okay, though we have a bit shortage of time, so what we are going to cover is we are going to cover the basics of CVP analysis, also the entire portion here, and also we'll be doing some questions. But yes, some questions I would be asking you to do when you receive the notes. Some questions will be done at your end. Okay, now let's quickly see CVP. So first let's understand the background, that what is a CVP analysis. So okay, let's have the background of the CVP analysis. What is CVP analysis? In simple terms, if I say no, it is nothing technical. It is just asking you to calculate the break-even point. And everything will be in relation to that break-even point. So here, simply we calculate what is the break-even point in units and revenue. You know that when I say break-even point, I talk about sale units. So we see here what is the sale quantity in units and total sales revenue. So the purpose here, you will say, ma'am, what is the purpose of CVP? Of course, CVP is just to analyze that, boss, when would you reach your no profit, no loss stage? Break-even point is no profit, no loss. Break-even point in units means if you sell till this number of units, then you will have no profit, no loss. And beyond that, the more the units that you sell, you will have profits only. Okay. Likewise, when we talk about revenue, break-even point in revenue would mean that this is the level of revenue if the entity earns, then assuming the cost remains constant and all, so then your profitability would be zero, because here you'll have no profit, no loss. Your profits will be equal to your fixed cost. Okay, your profits will be equal to your total cost. Clear? This is what we mean by CVP analysis. So CVP full form is cost volume profit analysis. Here we create a relationship between cost, sales volume and the profit. Okay. First important pointer is break-even point. So break-even point is that level of sale units wherein there is no profit, no loss, beyond which if the units are sold, it will be only profitable for the entity. Clear? Now let's see here. So let's look at the formula. How do you calculate break-even point? Before we go to the formula, why don't we look at an equation? We know one equation, that total cost plus profit is equal to sales. Correct? Okay, let me just break it. Or even I would just put it in another way. Just a minute. Because break-even point is a point where we don't have any profit or loss. So let me not include only any profit. Okay, now if I say at break-even point, total cost is equal to sales, right? Can we divide total cost, break it up? So I can say variable cost plus fixed cost is equal to sales. Okay, now I need to calculate the units. So I'm just telling you how the formulas are derived. So now if I keep fixed cost at one place, I can say that sales less variable cost, correct? If I take out the units, then I can say that sales per unit less variable cost per unit multiplied by number of units will give me the fixed cost. I'm just elaborating the formula, nothing else. I want to know this. I want to know this number of units. So how can I derive? I can simply say that now I want this on this side. I will take this formula on this side. So my number of units would be, I can say that break-even point in units is equal to fixed cost, because fixed cost is total always, remember. Total fixed cost total fixed cost divided by contribution per unit. Why? Because what is sales less variable cost? Contribution. So I can say that my fixed cost will be equal, my break-even point in units will be equal to total fixed cost divided by contribution per unit. I hope all of you are clear with this. Now if you want break-even point in revenue, simply multiply break-even point in units with the selling price. You get break-even point in revenue. You will say, ma'am, is there any other way to derive it also? Yes, we have. So now, have we ever heard of this CS ratio? CS ratio is simple, contribution divided by sales. Okay, so let's say contribution in dollar divided by sales in dollar, that is total value. So now get the CS ratio and then also we can derive break-even point. So break-even point in revenue, we call it as break-even point in revenue because we express as a total value. Okay, it will be equal to fixed cost divided by CS ratio. So you get the CS ratio, you divide the fixed cost by it, and then you get the break-even point in revenue. So now we have derived break-even point in units, we have got the break-even point in revenue. Next formula. This is for a single product that we are doing. We will be looking into the multi-products as well. Okay. Next point. So we have covered break-even point in units, break-even point in revenue. Another point is budgeted revenue. That is not difficult to get. The budgeted units multiplied by the selling price per unit. We have got this. Now another formula that comes up is margin of safety. Okay, another formula that comes up is margin of safety. Margin of safety would mean what is the difference between budgeted sales and break-even sales. Why? Because that is your safer zone, right? That is your safer zone. So that you don't, your margin of safety should never go below it. If it goes below, that means your break-even points and are even go below it. So that is going to give you a negative symptoms. I mean, negative, negative effects. Because margin of safety is the safer zone for the organizations. That we know if the margin of safety is, let's say 20%, that means budgeted sales are at least 20% covering for that break-even sales, right? So it is very much comfortable for the organizations to remain in that to remain in that margin of safety environment. Okay. So what is the formula for margin of safety? Let's look here. What is the formula for margin of safety? Okay. I hope we have covered everything. Yes. Okay, now margin of safety is, like I told you already, the difference. Budgeted revenue less break-even revenue. Ignore my handwriting, please. Just ignore my handwriting. Understand the logics and the concepts. Ignore my handwriting. So it is budgeted revenue less break-even revenue. Okay, that is margin of safety. How do you calculate it as a percentage? So margin of safety as a percentage will be equal to this difference that we got, that is budgeted revenue less break-even revenue divided by, just a minute. divided by budgeted revenue. Okay, so that we can get the percentage multiplied by 100. So we will get the percentage of margin of safety. Okay, and every organization should try to, minimize this gap. I mean, as in the budgeted break-even revenue to budgeted revenue. So we should try to reach the budgeted revenue sooner, right? That should be the aim of every organization. Clear? Guys, you are with me. So we have discussed break-even point in units, break-even point in revenue. We have discussed about margin of safety in percentage and value, right? I hope I'm clear, absolutely here for the single product. So let's quickly go and discuss these pointers and then we look at the multi-product. So now we know the logic of break-even point, right? And just few assumptions that I would like to tell you. This is a negative point for CVP analysis. This is a disadvantage of CVP analysis, that we take too many assumptions, though which are always subject to changes. Like number one, CVP analysis can apply to one product only. If there are multiple products, then we have the products in the weighted average ratio. So don't worry for that. Okay, then fixed costs are period cost that will remain same in total, and that is an assumption that we are carrying. The unit variable costs, they are constant, so per unit variable cost will remain variable. Okay, so that is again an assumption that we are carrying, that variable cost per unit will be constant, total fixed cost will be constant. Selling price are also constant in all levels of activity, which is practically not possible, but we take this assumption. Production volume is equal to sales volume, so no inventories is what we assume here. These are the four basic assumptions that we carry for CVP and that you would also be carrying with you in your exams when you do questions. Okay, so let's look at it further. Now these are some charts that I would like to quickly cover here. First is the break-even chart. Now look here. Break-even means that point where there is no profit, no loss. So I will relate it in the chart here. Break-even point is this point. Question will ask you, what is the break-even point? You will never answer this. You will always take it to the x-axis and say these are the break-even point in units. You will always take it to the y-axis and you will say this is the break-even point in dollars. This is never the right answer. Okay? You will see the question is asking you units or dollar, accordingly you will answer. Now what is the break-even point at which there is no profit, no loss? So this is that point where the total cost line and total revenue line intersect. Now do you observe total revenue will always start from 0 because at 0 units there are no sales. As revenue increases, units sold increases, revenue increases. You will see the total cost line. It will always start from a fixed level, which is your fixed cost. Because even if there is no sale, fixed cost is always going to be incurred. So we will always start at the fixed cost level and then it gets increased to this point. So what is this slope? This slope is your variable cost. So this slope gets the shape based on the the sales chart. So based on this sales chart, sales line, the variable cost line takes its slope. Clear? And this intersection point is the break-even point. Now let me explain you the margin of safety also. Let's see, this is my break-even point in units, in sales, and this is my budgeted units. So this is the margin of safety that we have kept, that we should try to minimize. Clear? This is the fixed cost, this is the variable cost, which is the total cost line less fixed cost line. This is the profit where sale is more than cost, and this is the loss where cost is more than sales. Right? I hope you all are with me on this. Any doubts, please ask me. Now let me take you the contribution break-even chart as well. This is the same chart, but not from the point of view of profits, from the point of view of contribution. So variable cost is the focus line here. So you will see your revenue cost is same. Break even point is same. This is also same. This is also same. Margin of safety is also same. And this is also same. Okay, so you will ask me that, ma'am, now what is the point? Why are you discussing this then? We are discussing it because let's focus on contribution. So here how we are plotting the line, because we talk about contribution. So our focus areas are selling price and variable cost. This is the selling revenue line and this is the variable cost line. Okay, so this is the sales revenue line. And this is the variable cost line. Okay, now you can see variable cost line also starts from 0. Why? I know you know it, because selling, if there are no units sold, no selling price, no variable cost, because here we are assuming production is equal to sales, no inventories as well. Okay, so now we know about it. Okay, let's take it further. Now, so now we know we start plotting by contribution. We start plotting by variable cost because we are looking at maximizing the contribution, right? So we will start with variable cost instead of fixed cost. Now the difference between total cost line and variable cost line is your fixed cost, which is evidently visible here. And your contribution is fixed cost plus profit, correct? So fixed cost plus profit is your contribution that you can see here. Clear? Let's go to the next chart, which is very important and you can definitely find it in your exam always. Section B, favorite. Section A, favorite. Okay? Very important. In fact, it is a part of section C also, small pointers. Now let's see the PV chart. PV chart means relationship of profit and volume. Okay, look here. So here this x-axis is basically representing sales volume if you are dealing in units. If you are dealing in break-even point in revenue, then it is representing revenue. Otherwise, it is representing units. This y-axis is representing profit on top and loss at the bottom. Now, when we plot this, so you know that in the beginning, like here, we knew because there is a level of fixed cost incurred, so there is a loss, right? So let's plot that loss line. Okay, so now here we will plot the loss because even if there is no production, fixed cost will always be incurred. So when there is zero revenue, we have fixed cost. As revenue will increase, we will reach the break-even point here. This is your break-even point and this is your budgeted levels. Finally, this is your profit, this is your loss that you're having. And this shows your contribution because contribution is fixed cost plus profit. So it will be from this to this. Okay, I hope I'm clear. So just understand what is the slope. The slope of this line is determined by contribution because that is the determining factor here. That how your line will go up diagonally like this. So it will all be depending upon contribution because it is a combination of profit and fixed cost. I hope the graphs are absolutely clear to all of you. Now let me just give you a detailing about multi-product break-even analysis and then we will do a couple of questions as well. Multi-product break-even analysis is basically where there are multiple products A, B, C, D. The company is not manufacturing single product, it is manufacturing multiple products. So then we will take weighted average. That's the only difference. We will in case of units, instead of taking contribution per unit, we will take weighted average. Instead of CS ratio, we will take weighted average. Easy? How do we do weights? We just assign weights to it, the ratios. What is the mix ratios? What is the units, sold? So units sold becomes the ratio. And that we take as the base to calculate weighted average. Now next very important point that comes here is, what is the sales unit at the break-even? Okay, what is the sales units at the break-even revenue? So either you get the sales units, multiply with the selling price to get your break-even revenue, or break-even revenue if you have, you can apportion it in the ratio of sales ratio. Like every unit has a particular ratio in which the goods are sold, that sales mix you will apply. So how will you get? For that you will need a revenue ratio, which is budgeted revenue divided of particular product divided by total budgeted revenue. This becomes your sales mix, in the ratio of which you will allocate the total budgeted revenue to the individual products. So at break even, if you want to calculate the revenue product X, that will be total break even revenue multiplied by this revenue ratio, or we also call as a sales mix. Okay, now likewise we had the PV charts prepared for single product. We will have PV charts prepared for multiple products also. You will say, ma'am, how would we prepare it? So guys, remember, calculate the contribution per unit for individual products. And if let's say there are three products, X, Y and Z, you will always plot the products, the first one with the highest contribution, then the next one that will be at that contribution, and then the third one in the ranking of contribution. So your ranking of the products in plotting will depend upon the contribution per unit of that product. Okay. Typically, we can also take the CS ratio also to plot it. Okay. And yeah, so here we can also take sales mix as additional basis. We can also take the ratio, the ranking of the products by their profitability. So in any case, the most contribution product, the most profitable product will be ranked first, then second, then third. If you're plotting revenue, then you will do it with respect to CS ratio. Right? Now we know about the limitations. The best limitations is all the assumptions are limitations. Because in practical situations, those assumptions don't hold true. Right? They don't hold true. How can you have fixed cost constant all the time? How can you have sales revenue to be same for every level of units? See, the more the units that you're selling, the more the selling price increase will be less, but there will be some effect. If you sell less units, selling price will be different. So accordingly, the inventory levels are not there, production is equal to sales. So there are so many assumptions that we are carrying which are not practical in the normal practical scenario. So this is the biggest disadvantage of CVP analysis. Now this PV charts, advantage, disadvantage we can go through, but let's look at some of the examples now. Okay, I've listed down many examples, some of which you will try back at home. Okay, so I have listed down, I believe, some 8 to 9 questions and examples. Now let's look at a very basic question so that we have absolute clarity of the thoughts. That is, a company has okay, a company has a fixed cost of 5,700, variable cost per unit of 6.5. Then, yeah. Okay, if the selling price is 8 per unit at all levels, what is the break-even point in units? Easy. What is the formula, my friends? The formula is equal to fixed cost by contribution per unit. Here fixed cost is how much? Fixed cost is given to you 5,700. So it will be 5,700 divided by contribution per unit will be 8 less 6.5, which is 1.5. So it will be equal to how much? Let's calculate. Okay. Let's calculate. So that will be equal to 5700 divided by 1.5. I get my answer as 3800. So break-even point in units is 3800. What is break-even revenue? You simply multiply 3800 with selling price per unit, which is 8. Right? So my break-even revenue will be 3800 multiplied by 8, and I get my answer as 30,400. You say, ma'am, is there any other way to do it? Yes, you divide it by the CS ratio. So look here, another way to do is I will calculate it here, which is equal to fixed cost, which is 5700 divided by the CS ratio. Okay, CS ratio is contribution per unit by sales price per unit. Contribution per unit, we have calculated 1.5 here. Okay, and my selling price per unit is 8. So I will divide it by 1.5 divided by 8. And you will get the same answer, which is 30,400. Any of the two ways you can adopt to get the answer. I hope very clear about it. Now let's go. We have discussed the CS ratio, which is 1.5 by 8. If budgeted sales are 5,000, what is the margin of safety in units? 5,000 is the budgeted sales. 3,800 is the break-even sales. So margin of safety in unit is 1,200. Very good. In percentage, so you will calculate it as 1,200 is the units divided by budgeted is 5,000 multiplied by 100. So my margin of safety is 24%, which is quite healthy. Okay, now let's go to the next one. Now the next one is, what will be the sales volume in units if you want a profit of 10,000? This is known as target profit. Additionally, to cover the fixed cost, we want to get the profit also. So in the formula where we write fixed cost, add profit over there, the target profit that you need. So here my target profit would be equal to 10,000. Fixed cost was 5,700, plus we want to cover additionally 10,000 of target profits as well, and this divided by the contribution per unit, which was 1.5. So we get the answer as 10467. That means if we do not want to achieve a target profit, then the break-even point is 3,800. Wait. And if we want to achieve a target profit of 10,000, then the break-even point increases to 10,466 units. Right? I hope I'm clear. Okay. So we are done with this. Okay, now I think there are many other questions that you can try, and if you want me to take a separate session on these other questions of CVP analysis, drop it in the comment section and I would come back again, or I would just come back again for one more YouTube live additionally to you, free of cost, for solving these CVP analysis questions that has got multiple products, how to calculate the break-even point in units, in revenue, margin of safety in case of multi-product environment. So guys, what are you waiting for? Drop it quickly in the chat box and I will come back to you with another YouTube live session for CVP analysis questions. But for today, let's close it here. I'm sure the 3 YouTube live sessions that we had, it gave you utmost crystal clarity for the topics that we covered. And if you find these questions, these topics related questions in the exam, I'm sure you're going to rock it and you will solve any question that you may be just finding in the exam. Okay, so again, drop your comments in the chat box for how did you like the YouTube live sessions. Do put in your feedbacks. If you want this Excel sheet, these notes, capsule notes, questions, I would share it with you. Just drop your email address in the comment section. Okay, as well as if you are interested to get the CVP analysis live YouTube videos, okay, or live YouTube live session only for CVP analysis question, we can have it. Okay, so for today, let's call it off a day. See you all the best, do well, and don't forget to join the live sessions for even more exciting content, even more detailed understanding, more conceptual clarity, 100% clarity, crystal clarity, and with lots of question solving at BB Virtuals Global for the live classes that are just going to start on 22nd September. For more details, you can connect with the counselor, you can connect with me, you can drop your comments in the chat box and we shall get back to you. But thanks a lot everyone for watching these videos and sharing the support. I hope so it served the purpose that it was meant to, that you all got 100% crystal clarity. So what are you waiting for? Join now. See you in the class. Good luck. Send your comments in the chat box.